Hi, and welcome to this week's The Mortgage Broker broadcast. I'm your host, Craig Skelton, and last week we explored the opportunities and pitfalls of the 2026 remortgage boom. This week we're keeping the focus a little bit closer to home with a simple message of do not lose your own. And as we know, the bulk of mortgage business in the UK is done through intermediaries. So there's always going to be competition between brokers, yet so many brokers still neglect their existing client bank. So today's episode is about the art of the annual review, why it matters, how to structure it, and how it protects both your clients and your business. But before we get into today's episode, I'm excited to share with you a preview of our new non-cast to AR Academy, a program that we're launching pretty soon to help inexperienced advisors get into the industry, achieve CAS, and eventually become appointed representatives. I'll explain more about it at the end of the episode. So let me just get into today's podcast. Why annual reviews matters. Annual reviews aren't just a tick box exercise, they're the best defense against losing your clients. Over the next couple of years, there's unprecedented churn in the mortgage market. 1.6 million deals in 2025, 1.8 million deals in 2026. External remortgaging is expected to rise by 10%, yet the majority of borrowers stay with their existing lender. And stats show that in recent years, 84% of remortgage deals were product transfers. That retention rate isn't because clients are just so happy or delighted with their existing lender. It's because many brokers fall off their radar. According to one lender, more than a quarter of clients introduced by brokers in 2021, so 5 years ago, contacted the lender directly when remortgaging and just bypassing their existing advisor. And as we know, when borrowers do nothing or they just go for the easy option of a PT, they can also pay for it. So why do they go for the easy option? Many people find that the whole process, they think it's going to be daunting, or they think that the whole remortgaging will be just as stressful as it was when they purchased their home and took out the original mortgage. And this context matters because your peers, other mortgage brokers, want your clients. Brokers' share of the UK mortgage market has grown over the past 3 years, and that growth will continue in 2026. At the same time, the number of UK mortgage brokers has increased too. So more brokers, more borrowers, meaning more competition. If you do not maintain the relationships you have already earned, you've already got, lenders and other mortgage brokers will. And as we know, many lenders are proactive, communicating with customers month before a deal ends, offering retention rates or removing the need for affordability checks. These offers may be convenient for the client, but they're not always in the client's best interest. Your job is to cut through all that noise and remind clients that you are the only one that's on their side. An annual review allows you to update their circumstances, explore options, and demonstrate value long before that lender email lands in their inbox. And if you don't make contact until a few months before the current deal ends, you're already going to be on the back foot. So, how do you go about designing an annual review? And a good annual review has three parts to it: preparation, conversation, and follow up. So let's start with preparation. Start by reviewing the client's existing mortgage deal, the balance, the interest rate, term, product, end date, ERCs, that sort of thing. And then look at the whys. Why did the client move there in the first place? Why did they buy that house? What was their motivation? And this will really help you with the conversation that you're about to have. What about the client's protection policies, or why didn't they take them out with you? Be aware of any key milestones such as children moving school or retirement age. Check the property's current value too, then work out the LTV. If the deal expires within the next 12 months, do a bit of research on both product transfers and remortgage rates so you know what the possibilities are. And then prepare questions about their goals, any life changes, new job, home improvements, things like that, growing family, plans to reduce working hours. Have a few pointers about what the conversation is going to look like. Let's look at the conversation. Start with curiosity. It's about them. You want to know what about them, ask about how their year has been and whether they've had any changes financially, anything been going on. If their priorities have shifted, people change. We all know that 12 months is a long time. So people change and their goals may have changed too. And then you need to make sure that in the conversation, you explain the difference between staying with the current lender and switching to a different lender as well. Product transfers, explain to them about product transfers. And yes, they're often quicker and therefore and avoid the affordability assessments, but they may not be the most competitive deal for them. So you need to explain that to them as part of the conversation. And don't stop at the mortgage. Use the review to check their existing protection cover. Discuss in any, have they got any savings, rainy day funds? Have they got wills and that sort of thing in place as well? Or do they need full financial advice? Again, with the annual review and the conversation, it gives you the chance to review what's in place, and also as well highlight anything that you may have missed when they took the mortgage out with them in the first place. So having that trusted partner really does work. Because the annual review is where you discover cross sales opportunities, but the primary goal is to ensure that the client mortgage still fits with their life and their needs. So once you've done the annual review, you also need to follow that up as well. So summarize the discussion in writing by email, clarify whether you'll revisit rates in a few months or if the time is right now to lock into their new deal because the deal's ending in 6 months' time. Agree next steps with dates, schedule the next touch point. Even if it's a brief sort of just checking call, there should always be a follow-up. The client should always know that when the next point of contact is going to be. The clients will know that you are present. And consistent follow-up turns the review from like a one-off meeting to the ongoing relationship. And that's what you need to have as a mortgage broker, the mindset of an ongoing relationship, which then in turn looks at making the annual contact a bit of a habit too. Too many brokers wait until 3 or 4 months before the current deal ends to call the clients, to contact the clients. That's often too late. You need to start the remortgage process in the final year of their current deal. So I'd say you should reach out at least a year before their existing deal comes to an end. At 12 months out, you're not selling anything at that stage, just simply just checking in, letting them know that you're around, any changes to their circumstances, any updates, anything like that. And then just tell them that you're going to be in touch near the time with exactly what the options are for them and the numbers too. That early contact ensures that they don't forget who you are. And when they start to get the lender's retention marketing, they're not going to pay too much attention to it because they know that you are looking after them. By building a simple contact strategy that works for you, friendly email, newsletter once a quarter, that sort of thing, a personalized email or phone call at the 12-month mark, a formal review meeting 6 months in, doesn't really matter, but you need to have some form of content strategy. And you can schedule this into your CRM so nothing is left to chance. And use social media to stay on the radar too, about posting videos explaining the remortgage timelines or difference between a PT and a remortgage. Being visible doesn't mean about being bombarding people. It means providing timely educational value so they remember your name when it counts. Because if you're not communicating with them, if you're not communicating with your existing clients, someone else will fill that void. So, what about balancing attraction and retention? Retention should come first, absolutely, but growth also comes from serving new clients. Make it easy for potential borrowers to find and trust you. Start with your online presence. Do you have a dedicated remortgage page on your website? Does it explain the difference between remortgage and product transfers? Outline the steps, processes, answer any sort of common questions. Educational content builds authority. Put blogs on your website, record short videos about topics about how long does remortgaging take, or should I fix or track in 2026? Share market insights. Host a webinar workshops on preparing for the 2026 remortgage wave. When people feel informed, they're more likely to reach out to you for that personal advice. You can also ask satisfied clients for referrals and testimonials. A simple post completion email that says, if you know nobody else that will benefit from a remortgage review, then mention me. That's absolutely fine. This can generate warm leads. There's something that I talked about before, which is about partnering with financial advisors or accountants or real estate planners who work with your ideal clients. Offer to provide them with like regular market updates in return for introductions. By combining retention with purposeful marketing, you grow your business without sacrificing the service you provide to those who already trust you. And use technology. Delivering annual reviews at scale requires smart systems. Ideally, should have a CRM or be very, very organized if you're doing everything manually. There are plenty of tools, software out there that can cut down or cut out the admin and ensure no client slips through the cracks. Automation should support you, not replace you, and shouldn't replace your relationships. Use email, texts for annual reviews, but make sure you personalize them too. And you can use AI for drafting emails or social media posts, but always make sure you add your tone and your expertise. Technology frees you up to spend more time advising and less time chasing paperwork, more time for you to build relationships with your clients. And along with that, it's about mindset and well-being, building a contact strategy, conducting thorough reviews, balancing new and existing clients requires discipline. It's easy to get caught up in the day-to-day tasks and forget about proactive relationship management. You need to be scheduling time each week to work on your business rather than just in it. Develop habits that support your energy. The mortgage market, as we know, can be and generally is very, very stressful. Remember your values. You start this business for freedom, to help people and build something that's sustainable. Annual reviews aren't just about keeping revenue, they're about keeping the promises too. When you look after clients year after year, trust compounds, and over time, those relationships become your brand. Don't let short term busyness distract you from long term consistency that makes your business grow and makes your business thrive. So that's it. Key takeaways for me is remortgage wave is huge. 1.8 million deals coming into an end this year. Remortgage volumes are expected to rise. Most borrowers staying with their existing lenders because brokers aren't proactively engaging with them. And as we know, client retention is always cheaper than client acquisition. So start early, initiate contact at least 12 months before the deal ends, design a structure review, get your data together, have a conversation that covers life changes and options, and follow up with clear next steps. Use technology smartly, CRM, automation, software, tools. Make sure that no client falls through the cracks and you can deliver timely advice for them. And mindset is everything. Set routines that support your well-being and remember why you became a broker, why you became a business owner in the first place. Discipline and reflection keeps you focused when the market, when our world of being in the mortgage industry is very busy. So that's it. That's this week's episode. Next week, we've got Jonathan Needham back on the podcast talking about the FCA and the removal of the advice trigger, which falls in nicely with what we've talked about over the past couple of ones. A preview of the non-cash to AR Academy that I talked about at the beginning. And if you're listening because you've got an aspiration to become a mortgage advisor, broker, get into the industry, or you know someone that does, very soon we're launching the non-cash to appointed representative academy, a structured program designed to take inexperienced advisors from training to competency and eventually become an appointed representative. It will offer one-to-one support and mentoring along with the supportive peer community who are going through the same things as you're looking to do. And if you want to build a career with integrity and avoid the hype, and there's plenty of hype in our industry, that is absolutely for you. So reach out to me on LinkedIn, register your interest, ask any questions you want to, and I'm going to share more details over the coming weeks. Thanks for listening as always. Thanks for watching. Thanks for subscribing. Please leave a review. Please share it with other brokers. And as always, don't get distracted by whatever everybody else is doing, all that noise. Don't rush the process. Don't lose your own. As I've said, run your own race. And I'll see you next week.